Am I looking at you the whole time?
Now, our next guest is feeling cautiously optimistic, though he's not bullish just yet. He's Darren Farwell, Senior Wealth Advisor at Farwell Wealth Management. He joins us for a closer look. Is this just the holiday spirit that's got you a little more cheery here?
Well, one of the things that's got me feeling better is there's a real lack of bad news, bad data out of Europe.
No news is good news.
In this case, no news is good news when it comes to Europe, because that lets people shift their attention away from what's going on over there a little bit to what's been going on behind the scenes for some time, but heads starting to peak up even a little bit more in the United States.
Well, as far as the Eurozone goes, though, we now know a lot more cash has been earmarked by the ECB.
Yes.
So I suppose now it's a function of we're throwing money at the problem. Let's see if it sticks.
Right. It's a solution we've heard before. United States have done it. I think most experts realized at some point Europe was going to have to get their act together and throw some money at the problem, as they've said. But there's some other things that we're starting to see which are just as important as the throwing money at it. And one of them is that they just seem to keep moving forward, little by little, step by step. We're not seeing a lot of dissension. We haven't seen problems like we saw in Greece for some time now. We haven't seen disruptions like what was going on in Italy for some time now. They seem to be moving towards solution. And let me add one more thing. Just recently, China decided to buy a significant percentage of some state-owned power utility assets in Portugal. So there's another way of getting money into the balance sheets of those governments.
I can't imagine Beijing is not licking its chops at the prospect for picking stuff up on the cheap in the Eurozone.
Right. Well, when you've got cash, you can buy when things are low.
Well, it's a topic of cash, though. We spoke recently, and I think you had like 30 out of every 100 investable dollars sitting on the sidelines.
Yes, we did.
Is that still the case?
Not the case now. We're still cautious, as you had said, because we know that some bomb coming out of Europe could easily derail what is still a somewhat fragile recovery. But the fact of the matter is, particularly in Canada, the market's gone down quite a long way. And when we're looking at the year-to-date numbers, we're saying this is the time you can start picking away at some good quality stocks with dividends, because you can't live on cash very long.
But we've been seeing a lot of that over the course of not just the last year, but over the last 2 or 3 years, a return to that dividend strategy. And that was one of the reasons why you were recommending my parent company, BCE.
Yes.
But you had also pointed out that you're not just going to hold this and walk away. There is a point at which you would want to hit the sell button. Are you getting anywhere close to that?
There are some stocks that we are, and some of the high dividend-paying stocks are just an example. We've been buying Bell for some time, but now we're getting up towards the 42.50 sell target for us. We'll decide when that comes whether we sell or not. And remember, we talked about Pfizer. And Pfizer, there was some question of whether they would actually reduce the dividend.
Right.
Well, instead they've increased it. And that stock's starting to get towards our sell target. So we're selling some of these companies just because we've made as much as we feel comfortable with.
Right.
And maybe we will go to the sideline and buy something else.
I guess the idea is you've got the bulls on the market, the bears in the market, but it's the pigs that get slaughtered. So you're locking in some profit here.
We are. And I think there can be a little bit of rotation, because if we're correct about our thesis that we're heading more towards a positive bias on where we're going next year, then we do want to move a little bit more into those more aggressive names.
So does that include energy?
It definitely includes energy. We've talked about Progress Energy, one that we still really like. But we've even added recently tech to our radar screen, and tech just because of their exposure to commodities.
All right, but there's Progress right now. PRQ is at $12.76. Tell me what that sell point would be for you and why.
For us, the sell point on Progress would be, we'd probably start to look at it at 16, but more importantly, $18 is our target.
Why? Well, what is it about that magic number?
Well, we think energy prices are going to go higher, and that's going to pull the stock higher just on an earnings perspective. And once we've made that much money on a stock, we feel that, plus our dividend, it's time to think about moving into something else.
Okay, but as far as getting into more riskier names within the energy space, we're looking at crude oil now at $99.70 a barrel. If the Eurozone players don't get their fiscal houses in order in 2012, wouldn't that put downward pressure on the price for a barrel and therefore the stocks underlying them?
Absolutely. And that's why, as I say, we are starting to nibble away, but we've been waiting to get into the market aggressively to bring our cash levels down to 10%. We'd really like to see one of two things. Either some chaotic outcome in Europe, which means we get into bear market territory and we can buy down 20-25%. We'd be buyers then.
Right.
Or there's a plan on the table that everyone goes, that's a good plan. We can live with that. Everyone agrees it's good. We'll buy then. So now we're just cautiously buying when prices seem particularly good.
You mentioned Tech Resources. Is this basically old King Coal and a play on China?
It's a play on commodities. China certainly helps that story, but it's a play on commodities. I mean, if you look at the chart on most commodities, they started at the top in January and have gone straight down to the end of the year.
That's what we're looking at.
It's a good time to be buying some of those commodities if you believe that we're moving to an area of higher growth around the world, which we do. We think that's the bias.
Higher growth around the world. Okay, so globally speaking, because again, back to that China thesis, we know that China is slowing.
Right.
Granted, even at a 4% GDP rate, that's something that the rest of us would be more than happy with. So this is, you don't expect the global economy to be slowed by the Eurozone crisis?
It's already slowed, so it looks like the world's all... For example, if you look at the TSX to bond ratio in Canada, I mean, we're looking at a 20% lag on the TSX relative to bonds through this year. Well, that's an historically high number. If you buy at that level, you're probably in for some good returns in the next year.
Have you been doing any tax loss selling?
There has been some tax loss selling, and some of the tax loss selling was simply for that reason. If you'd had capital gains in previous years and you'd like to get some money, some of that money back, we have been selling some things. And we were busy with that today, in fact. That's why I was kind of rushed getting here.
Yeah, today was the last day.
Today was the last day in Canada.
In Canada. And as far as things go for 2012, sort of stay the course, but get a little bit riskier is what you're saying.
Get a little bit riskier. Be careful of the headlines because they could still jump up and bite you, but we're definitely getting a little bit riskier.
Darren, great having you with us again. All the best for the holidays.
Thank you. All the best to you.
Thank you. Darren Farwell is a Senior Wealth Advisor at Farwell Wealth Management. Statistics Canada is taking